Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Eightco.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just jump right in.
Yeah, let's do it.
Imagine you're walking into this, dusty, totally boring factory on the edge of town, like a place that just makes everyday cardboard boxes.
Right, very traditional.
Exactly. You walk past the assembly lines, you open a random broom closet in the back, and suddenly you're staring into a state-of-the-art digital vault.
Oh, wow.
And inside that vault, 10% of a global cryptocurrency supply and tens of millions of dollars worth of Sam Altman's private AI empire.
It's a pretty jarring contrast, honestly.
It really is, and that is exactly what is happening inside the stock we are looking at today. We are exploring a company that's undergoing really one of the most radical corporate transformations the market has seen in years.
Yeah, Eightco is basically getting its legacy identity.
Right, moving totally away from being a traditional packaging operating company and emerging as this high-growth investment holding vehicle.
And our mission for this deep dive is to figure out if that drastic metamorphosis actually presents a genuine wealth-building opportunity for your portfolio. Or, if it's just a flashy illusion.
Which is always the fear with these kinds of pivots.
Exactly. So we need to look under the hood at the specific assets in their new treasury. We also need to analyze this incredibly unique strategy they're deploying.
The access mode.
Right, the access mode.
Sure.
And perhaps most importantly, we need to make sense of the highly volatile, often contradictory price action we've seen on the charts over the last few weeks.
Because when a business abandons its foundational model to do something completely unprecedented, the market reaction is, well, it's rarely straightforward.
Almost never.
So I really want to start with that treasury makeover, because to understand the wild swings in their stock price, you have to grasp the sheer scale of what they're accumulating.
Yeah, they aren't just dabbling on the side while still focusing on boxes.
No, not at all. That traditional operating revenue from the packaging solutions is now entirely secondary. The true engine of the company has totally shifted.
It has.
But I want to get the numbers straight for the listener. What exactly is sitting inside this newly constructed digital vault?
Well, the digital asset accumulation is staggering. On the cryptocurrency side alone, they currently hold over 277 million WorldCoin.
Wait, 277 million?
Yeah. To give you a sense of scale, that represents nearly 10% of the entire circulating supply of that specific token.
10% of the global supply.
10%.
Controlling nearly 10% of any global asset supply is a huge red flag for volatility. But, it's also an undeniable amount of leverage.
Exactly. And in addition to that, their vault holds over 11,000 Ethereum.
And holding that much Ethereum right now feels incredibly strategic, doesn't it?
Oh, the timing is critical. Ethereum recently surged 8% in a single 24-hour period.
Wow.
Furthermore, Eightco's strategic partner Bitmine, they just purchased nearly 61,000 Ethereum themselves.
So there's this sprawling off-balance sheet upside potential happening too.
Right. But to really grasp why this matters for a stock investor, we have to talk about how the valuation mechanics of this company have fundamentally changed.
Okay, break that down for us.
We are moving away from a traditional profit and loss statement, where an analyst looks at how many physical boxes they sold last quarter versus the cost of raw cardboard.
Right, the old way.
Yeah, and we're moving toward a model based almost entirely on mark-to-market appreciation.
So it's essentially like flipping houses, right?
How do you mean?
Well, a traditional profit and loss statement is looking at how much rental income a property generates every single month. It's cash flow.
Right.
But mark-to-market accounting is just looking at the Zillow estimate of the house going up and down every single day based on the neighborhood, regardless of whether anyone is actually paying rent. Am I understanding that correctly?
That is a perfect analogy. And in wealth building, this distinction changes your entire investment thesis.
Because the revenue isn't coming from sales anymore?
Exactly. Mark-to-market means the reported value of the company is intrinsically tied to the real-time fluctuating value of the assets they hold, not their operational cash flow.
So when their quarterly earnings reports come out, they might look incredibly strained.
Oh, they might even look alarming to a traditional value investor who is hunting for standard operating profit. They might show zero revenue growth in the traditional sense.
But beneath the surface.
Beneath the surface, the true net asset value of the company could be skyrocketing simply because the broader crypto market moved up.
Their underlying value expands rapidly without them having to manufacture or sell a single physical product.
Exactly.
But my biggest fear hearing this is dilution. Whenever I hear about a small cap company pivoting aggressively into crypto or venture capital, my immediate thought is that they are just burning cash.
It's a valid concern.
To fund a vault like this, aren't they just going to bleed everyday retail shareholders dry by issuing millions of new shares?
That is the structural risk that usually plagues early-stage holding companies, absolutely. But a look at their balance sheet tells a different story here.
Okay, what are we looking at?
They have constructed what appears to be a financial fortress. Current filings show $76 million in total cash and stablecoins.
Wow, 76 million.
Yeah, that gives them a substantial runway to execute this pivot without the immediate threat of shareholder dilution.
Okay, let's clarify stablecoins for a second. We hear that thrown around a lot. Why hold stablecoins instead of just keeping $76 million in a standard checking account at a major bank?
Well, stablecoins are digital currencies pegged directly to a fiat currency, usually the US dollar.
Okay.
So they offer the stability of cash, meaning they don't swing wildly in price like Bitcoin or Ethereum, but because they live on the blockchain, they can be deployed instantly.
Ah, so they can be moved into decentralized finance protocols to earn yield.
Right, or transferred globally in seconds to execute massive private equity purchases. It provides the liquidity of cash with the agility of crypto.
That makes a lot of sense.
And beyond that war chest, if you dig into their filings, you will see specific debt restructuring entries scheduled for late 2025.
Meaning what exactly?
Management isn't just buying shiny digital tokens. They are proactively clearing out the legacy liabilities and old debt from the packaging days. They're scrubbing the financial structure clean.
Okay, having a vault full of crypto is one thing. Plenty of companies have tried the whole put Bitcoin on the balance sheet playbook.
True.
But what caught my eye in the research is their push into private tech. What is the real draw here beyond just riding the crypto wave?
The true differentiator and what is actively drawing in heavy institutional money right now is their aggressive move to secure exclusive equity in private mega unicorns.
So not just publicly traded tokens.
No, they're entering the elite, highly restricted private equity space. We are talking about the leading artificial intelligence company in the world.
OpenAI.
Yes, Eightco recently injected another $40 million into OpenAI.
Wait, another 40 million? Where does that put their total position in OpenAI?
That brings their total position to $90 million.
Wow.
Roughly 30% of Eightco's entire treasury is now sitting in Sam Altman's AI enterprise.
That is massive.
And they're also securing equity in Beast Industries, which is the sprawling enterprise behind the creator, Mr. Beast.
Okay, I need to stop and ask about the mechanics of this, because why can't I just go onto my regular brokerage app on my phone and buy $100 worth of OpenAI or Beast Industries myself?
You can't.
Why do I need to care that Eightco's buying it?
Because the most lucrative phase of a company's growth almost always happens before it ever goes public.
Right.
But the regulatory hurdles deliberately lock the everyday retail investor out of that wealth generation phase. To buy into private equity rounds like OpenAI, you legally have to be an accredited investor.
Which means what for the average person listening?
It means proving you have a high net worth, usually over $1 million excluding your home, or meeting strict income requirements.
And even if you meet those, don't private companies set massive minimums?
Exactly. Private companies often set minimum investment thresholds in the tens of millions. The everyday investor simply does not have the legal clearance or the capital to participate.
So Eightco is essentially acting as a legal bridge.
Yes.
By holding these inaccessible assets within a publicly traded vehicle, they're creating what we called an access moat.
Precisely. Since retail investors cannot buy private OpenAI shares directly, it creates a massive scarcity premium for Eightco.
If you want exposure to that specific private asset in your standard retirement account, you have to buy Eightco stock.
That is the exact mechanism. They are democratizing access to elite venture capital through a public ticker.
But I have to push back on the reality of this. Giant legacy institutional funds with billions of dollars under management are practically fighting in the streets for scraps of OpenAI equity.
Oh, absolutely. It is the most sought-after asset on the planet right now.
So how does a former packaging company just waltz into Silicon Valley and secure a $90 million allocation?
The answer to that lies entirely in the strategic network they have meticulously built behind the scenes.
Okay, who are we talking about?
Well, in private equity, capital alone isn't enough. You don't get into those funding rounds without the right introductions and validation. Look at the board of directors and the advisory team they're assembling.
Right.
They recently brought on Tom Lee, the chairman of Bitmine, to the board. And even more tellingly, They brought on Brett Winton, the chief futurist at ARK Invest, as an advisor.
Wow, those are heavy hitters. I mean, ARK Invest is famous for their aggressive targeting of disruptive innovation.
Exactly.
When Brett Winton is advising you, it sends a huge signal to the rest of the market that your tech thesis is legitimate.
And this network isn't just providing friendly advice over coffee. They're providing hard capital.
How much?
Eightco recently received a $125 million capital injection.
Wow.
And that round was led by Bitmine, ARK Invest, and Payward, which you might know better as the parent company of the Kraken crypto exchange.
Ah, Kraken, right.
That $125 million syndicate is what actually funded the monumental OpenAI purchases and de-risked Eightco's balance sheet.
So, to answer my own question, the cardboard box company didn't get the allocation.
No, they didn't.
The newly formed, heavily backed, strategically connected investment syndicate got the allocation.
You nailed it.
Okay, so if we logically follow this through, you have the $90 million in OpenAI, the sprawling crypto holdings, the backing from ARK Invest and Kraken's parent company, and the fortress balance sheet.
Right.
If I am a rational investor, I would expect the stock chart to reflect that. I'd expect a straight vertical green line.
Sure, that would make sense in a perfect world.
But the reality on the charts tells a story of wild discovery and absolute market confusion.
Which is incredibly common for a microcap company undergoing a structural pivot of this magnitude.
Because the market just doesn't know what to do with them.
Exactly. The market simply does not know how to accurately price them yet because their old algorithms are still reading the data of a packaging company.
We saw this play out perfectly in mid-March. On March 16th, there was a classic breakout. Shares surged almost 35% in after-hours trading when the news of the Bitmine investment broke.
Right, a huge logical pop.
But then, on March 20th, they announced the highly bullish news of the $90 million OpenAI stake. You would think cementing a position in the biggest AI company in the world would send it soaring again.
You would think so.
Instead, the stock actually dipped. It fell 2.53%. Closing at 92 cents, dropping on good news. How should you, as an investor, interpret this bizarre contradiction?
Well, this brings us to a crucial lesson in market psychology and the mechanics of what traders call a sell the news event.
Okay, explain that.
When a stock pops almost 35% overnight like it did on the 16th, you immediately attract short-term momentum traders.
Right.
These traders do not care about the long-term wealth-building potential of a private AI investment. They're strictly looking to scalp a quick profit.
So they're just riding the wave.
Exactly. So when the next piece of big news hits the OpenAI announcement on the 20th, those short-term traders use that high-volume event as an exit liquidity pool.
Wait, let me translate exit liquidity pool for a second. You mean the big institutional traders and day traders are essentially using the hype generated by the word OpenAI to find enough eager retail buyers so they can offload their own shares and cash out.
That is precisely how it works. The hype generates a flood of buy orders from retail investors.
Right.
The momentum traders who bought in days earlier see that surge in volume and sell their shares into it to lock in their 35% profit.
And that heavy selling pressure drives the price down slightly.
Exactly, creating a red day on the chart, despite the underlying news being fundamentally, undeniably bullish for the company's long-term value.
And we can see this confusion playing out in real time across the financial media. The sentiment analysis is completely fractured.
It's all over the place.
You look at the news scanners, and on one hand, you have bearish headlines blasting, stock falls despite $40 million investment. But right next to it, on the exact same day, you have bullish headlines saying, stock is trending overnight after popping 34%.
Yeah, it is no wonder this stock is repeatedly triggering the unusual volume alerts. The market is violently trying to figure out what this new entity is actually worth.
So who is right, the buyers or the sellers?
To figure out who is right, the critical metric to watch is what the insiders are doing. We are currently looking at a healthy consolidation phase, where the weak hands, the short-term swing traders, are taking their profits and exiting.
Okay.
But if the people who actually know the inner workings of the company thought the stock was fundamentally overvalued after that initial pop, they would be selling their own equity.
Right, they'd be cashing out too.
Instead, SEC filings show the exact opposite behavior. Insiders are actively extending their lockup agreements.
Just to be clear for everyone, a lockup agreement is a legally binding contract that prevents company insiders and early investors from selling their shares for a specific period of time.
Correct.
So by extending it voluntarily, they are literally trapping their own capital inside the stock.
Yes, they are legally barring themselves from dumping shares into this current volatility.
Wow.
They are quietly accumulating and extending their commitment, which sends an immense signal of confidence to the market.
Because it tells us that management believes the current 92-cent share price does not even come close to reflecting the long-term value of the treasury they are building.
Exactly. The institutions and the insiders are playing a multi-year chess game, while the retail momentum traders fight over pennies on the daily chart.
Okay, so if the insiders are trapped in these lockups and the retail market is confused by the changing narrative, what is the actual trigger that forces the market to wake up and price this stock correctly?
That's the million-dollar question.
Because to make an informed wealth-building decision, you have to weigh the impending catalysts against the very real structural risks, because this is undeniably a speculative play. So what is the core bear case here?
Well, the primary risk comes down to the valuation gap and fear of the unknown.
Minu.
Even with $76 million in cash on hand, that recent drop on the OpenAI news indicates lingering market anxiety. Investors are worried about exactly how that additional $40 million OpenAI injection was funded behind closed doors.
Right.
There is a persistent fear that, despite the current cash runway, there will eventually be a massive share issuance down the line to cover these aggressive venture capital buys.
And then there is the elephant in the room, asset concentration.
Oh, definitely.
I mean, tying 30% of your company's entire treasury to a single private AI company, even one run by Sam Altman, is a highly leveraged, risky bet.
It is.
And when you combine that with a heavy reliance on volatile cryptocurrencies like WorldCoin and Ethereum, it raises a serious question. Is this brilliant foresight building a modernized digital vault, or is it incredibly reckless concentration?
Right, because if the broader crypto market crashes tomorrow, Eightco's balance sheet crashes with it.
Exactly.
And that is the literal definition of the risk profile here. It is exactly why the analysis categorizes this stock strictly as a speculative hold.
Okay, speculative hold.
Yes, it is a high potential, high volatility vehicle. It offers what we call high beta exposure.
Let's define high beta exposure quickly for the listener.
Sure. Beta is a measure of stock's volatility in relation to the overall market.
Okay.
A beta greater than 1 means the stock is more volatile than the broader market.
Got it.
So high beta exposure means this stock will swing wildly. If Ethereum drops 20% in a week, Eightco's net asset value takes a brutal hit.
And if the AI sector cools off, that $90 million OpenAI stake suddenly looks like an illiquid liability.
Precisely. However, the bullish counterargument is that the current market capitalization of Eightco likely significantly undervalues the total sum of those underlying treasury assets.
Because the algorithms are still looking at cardboard boxes.
Yes, because algorithmic trading bots are still pricing in the revenue of the old packaging operations, the fears of future dilution might be heavily overblown compared to the raw, intrinsic value of what they currently hold in the vault.
Which brings us back to the triggers. Over the next 3 to 6 months, there are specific events on the calendar that could force those algorithms to reevaluate this stock.
Right.
What are the major catalysts we are watching?
The most explosive catalyst is the persistent rumor swirling around an OpenAI public listing later this year.
An IPO.
Yes. If OpenAI decides to IPO and go public, it triggers an unprecedented liquidity event.
Wow.
Suddenly, that $90 million illiquid private stake held by Eightco has a public, highly liquid market value.
And that transparency would almost certainly force a rapid re-rating of Eightco's stock price by Wall Street analysts.
Without a doubt.
You also have to watch the broader crypto market momentum, since any positive movement in the digital asset space directly inflates their net asset value.
Absolutely. But for the traditional finance world,
Yeah.
Value investors who don't care about crypto Twitter or venture capital rumors, the real catalyst might just be the upcoming 10Q financial filings.
Oh, that is an excellent point. Traditional financial algorithms and institutional screeners often ignore flashy press releases.
Right. They only react to official, audited SEC filings.
So when Eightco's next 10Q drops, it will finally reveal the full extent of this treasury appreciation in black and white accounting terms to the traditional finance sector.
Exactly. They will clearly see the crypto balances, they will see the formalized OpenAI stake, and they will see the extended cash runway without the noise of the media sentiment.
Okay, taking all of this into account, the undeniable risks of heavy asset concentration, the explosive potential of bridging the private equity gap, and the immense insider confidence shown by the lockup extensions, the research gives this an 8 out of 10 bullish score. The final verdict here is a speculative hold with a 6 to 12-month horizon. It is viewed as a classic opportunity to buy the dip for a portfolio looking for aggressive growth exposure.
But it is vital to emphasize the word speculative.
Right, definitely.
This is not a stable blue-chip dividend stock you ignore for 20 years. This is a targeted vehicle designed to capture the extreme upside of private AI and digital assets, carrying all the inherent volatility that entails.
By investing here, you are essentially betting that their elite network of advisors and their fortress-like balance sheet will allow them to navigate the turbulent tech landscape far better than you could on your own.
Exactly.
Well, let's bring all these financial metrics, the accounting shifts, and the strategic moves back to the core takeaway for your wealth building strategy.
Sounds good.
Eightco is a completely transformed entity. They have hollowed out a legacy business and filled it with unparalleled retail access to the world's leading AI company, alongside substantial digital asset holdings. And they have done it while being backed by institutional titans like ARK Invest and Kraken's parent company.
It really serves as the ultimate modern example of a company attempting to bridge the divide between inaccessible private wealth generation and the everyday public markets.
It really does.
But I want to leave you with a new angle to ponder, something that really turns this entire investment thesis on its head. Think about this carefully.
Okay, let's hear it.
Eightco's absolute biggest selling point right now, the reason they're drawing so much attention, is its exclusive access moat to OpenAI.
Right, they are the only game in town for retail investors who want a piece of Sam Altman's company.
But if that rumored OpenAI public listing actually happens later this year, everyday retail investors will suddenly be able to buy OpenAI directly on the open stock market using their own brokerage apps.
Right.
So ask yourself, does that massive IPO liquidity event send Eightco's valuation to the moon because their assets are suddenly liquid and publicly priced? Or does it permanently erase their main competitive advantage, leaving them completely without their protective moat? That is a fascinating question.
Thank you for joining us for this deep dive, and as always, keep questioning the obvious in your wealth building journey.